This paper is about local finance and local growth in China. There is a traditional problem in China's banking sector that the state-owned banks, especially the big four banks, for example, Bank of China, these banks are often accused for its inefficiency by mainly lending to large, inefficient SOEs. In face of this problem, China bank regulatory solution is that to establish city small banks. City commercial banks operated in only that city in China is to promote small and medium firm growth to lead to local economic growth. However, so this gives you a rough picture of how many city commercial banks have been established in China. You can see that it's quite spread out in China. And so here is a quick glance of city commercial banks, which are the small banks. Usually, we want small banks to lend to small firms and to lead to growth. So by 2010, 147 city commercial banks in 147 cities. So, there are 286 cities total in China. Location is recognized from its name. For example, Bank of Zhejiang is in the city of Zhejiang. Before 2006, only operated in its own city. Between 2006 and 2008, very rare cross-region branching. After 2008, most of their business is still in its own city. And in 2010, the asset to city's GDP is 22.5% on average. If you consider the city core area, then the percentage ratio would be quite high. The CCB, where did the CCB come from? CCB built on cooperatives, but very different. Cooperatives have very strict deposit taking and loan issuance limits according to the regulation that deposits from non-cooperative members should not exceed 40% of all deposits, and deposits from any single individual could not exceed 150,000 RMB. Loans to any single client could not exceed 500,000 RMB, and the loans to the non-cooperative members could not exceed 40% of all loans. So, for example, the Bank of Shanghai was founded by merging 98 urban credit cooperatives at the end of 1995. In just 1 year after Bank of Shanghai was built, total assets increased by 89, close to 90%, and the total loan increased by more than 80%. So the quantitative change is large. There is an advantage in studying decentralization in China. China has a much more decentralized political structure. According to Laundry 2008, the commonly adopted measure for decentralization, the ratio of central government expenditure to total government expenditure is below 20% in China, in contrast to an average of 75% in democracies. So, however, according to KPMG's report to foreign banks, that city commercial banks are widely perceived to be heavily influenced by their local governments. There is a widespread corruption news for city commercial banks. For example, in the year of 2013, the Sister of Housing, top news in 2013, Gong Ai, which is just a manager in the local city commercial bank of a small city, owns houses, worth of $2 billion in Beijing. So there are other cases as well that there is widespread news, like in the shareholders, there are some 6-year-old kid in the, sitting in the city commercial bank as a shareholder. Borrowers, and who they are lending to? Borrowers information available for the top 9 banks. In 2010, most of the top 10 borrowers from the top 9 banks were still state-owned enterprises or public institutions. So here is a top 3 banks, the Bank of Beijing, Bank of Tianjin, and the Bank of Shanghai. You can see from the right-hand side that these banks, these are mostly, the borrowers are still, the largest borrowers are still state-owned enterprises, where at the same time, China's private enterprises actually taking a much larger share. So, which means there are a lot of large firms as well. The main result of this paper is that using the macro data set, CEIC, for city-level data, and the Chinese annual census of enterprises is from 1997 to 2007 for firm-level data. We use methodologies, difference. We found that city commercial bank establishment actually lowered SME firms' growth rate more and lowered city GDP's growth rate quite significantly, robust to every estimation, which is totally opposite to the bank regulatory's original intention. So, and if we use bank efficiency measure, we found that CCB is even less efficient than Big Four. There is possible reason is that since 1994, China has centralized its monetary authority, but refusing to accommodate monetary policy to the local government behavior to harden the budget constraint. The decentralization of monetary policy would loosen firms' budget constraint because the local government would bail out inefficient firms. Local city branches of Big Four, with almost every city presence, have a balance of power among the headquarters in Beijing, local city government, and the provincial branches, where local government has its sole power with over CCB's operation. And the CCB functions as an alternative for monetary decentralization. Local government is more willing to loan to SOE or large firms which have more bribery power or bring more brand reputation to the city to be credits for local government official promotion. For grounding capitalism with Chinese characteristics, that the local government obtain economic benefits such as bribery from firms and consequently help firms' business, such as credit allocation. So this morning, we talked a lot about the doing business index, that in China, if we see the doing business index is quite low. But actually, if you in China, because of this crony capitalism, firms, they face, so governments have the competition to promote GDP growth and everything. And so if you know the politicians, doing business would be the easiest in China. And for example, the former top official Bo Xilai, firm gave funds for his son to study abroad. And here's the related literature. There is a large literature in finance and growth, whether financial development lead to growth or not, in the size of quantity change, more financial size. And for finance and growth for China is that some paper John's found that there is a positive effect, and but other papers like Debris and Wei Shangjin, the papers they found in China is negative because the state-owned banks, they are quite inefficient. And for the firm's growth and finance as well, Franklin Allen, 2005 papers, they found that in China, the financial development or banking development does not matter in China at all, because on the one hand, they are inefficient. On the other hand, the Chinese, there is a lot of interpersonal lending or formal finance, informal finance in China, which actually help firms' growth under China's weak institutions. But Iagari's paper using World Bank's survey data found that they actually increased firms' growth rate. And the other paper I want to talk about the TVE, which means the government ownership of firms. The Jane and Chan's paper published at QGE saying that local government ownership of local firms actually help China's growth because local government can protect their local business from the grabbing hand of from the central government in China, so that they actually can provide protection of property rights. But my paper is different in the sense that when it comes to credit allocation, the local government did a bad job. So this is data, which is first for the macro level data, we use CEIC data set and various statistical yearbooks, and for 286 cities. And we use China Industrial Enterprise Database, which composes almost every firm in China as long as their revenue, yearly revenue is above 5 million yuan. So the quantity is quite small. So which means that most of the firms are included in the database. And with firms with 4 consecutive years of growth, we have more than 200,000 firms. And we manually collected the CCB's information. And for the methodology, we use the difference in difference technique, which means G, which is on the left-hand side, is cities or GDP or GDP per capita's growth rate for city I at year T. C is constant, alpha T is year fixed effect, beta I is city fixed effect, CCB is a dummy, whether the city has a CCB presence or not, and XT, IT are other control variables for that city. So here's a summary statistics. So here's the standard deviation, 0.03. So 3%, close to between 3 or 4% standard deviation growth rate. Later on, we will see how CCB explains this standard deviation change. For the methodology, for the firm level growth rate, so IGT here, everything is the same as the macro growth model, except this is for the firm growth rate. And later on, we will use a heterogeneous impact, which means we will use interaction terms that the CCB times the total asset of the firm. Okay. So here's the summary statistics for the firm level. And there is due to time constraint, I go quickly on the methodology side. There is endogeneity problem that we solve the endogeneity problem by using because CCB might be constructed because city growth rate or might be omitted variables such as institutional quality affecting both CCB and growth. So we use IV, which is a percentage of neighboring cities having established the CCB. Why? Because of policy diffusion, that neighboring regions are much more likely to adopt a similar policy. If we look at this picture, for example, I'm from Henan, my hometown, that first it's centered at my capital city in my province, Zhengzhou, and then it is spread to other cities, then to the other cities which are more far away. And and we use a 2-stage listed square with the first stage as follows: the CCB as the left-hand side and the neighboring city, which is whether the neighbor city has established the CCB or not on the right-hand side. And so here's the macro result. We see that the established of CCB, the dependent variable is the growth rate of GDP, whereas the right-hand side, the independent variable is CCB and other control variables. We see that the establishment of CCB lowered cities' GDP growth rate significantly, but even we add more control variables. And one thing I want you to note is that for the coefficient of loan, we found that more loan growth in that city actually lowered the city's GDP growth rate. So this is a similar result with Wei Shangjin's paper that, and the Debris paper that more financial development in the sense of quantity change, quantity increase would lead to lower growth rate in China because of the inefficient banking system in China. And whether there is a learning effect, our answer is no. CCB year denotes how many years the CCB has established. We can see that more years established actually lowered CCB's the GDP growth rate more. And if we use a lagged effect, we use a lag variable of CCB, we find that still it's negative for GDP growth rate. And for growth rate of GDP per capita, we still find that the change, the results are quite robust as well, in the sense that is significantly negative. And here's the growth rate of number of industrial enterprises above designated size. We find that either insignificant or negative because it's a designated size, which means some small firms, they are omitted. So that might explain the insignificant part story. And the growth rate of industrial output, and most of the time significantly negative, which means the establishment of CCP in that city comparative to other cities actually lowered not only GDP growth rate, GDP per capita growth rate, but also industrial output growth rate. And so here's a firm level data. We have close to 1 million observations. And we find that the establishment of CCP actually reduced the firm's growth rate in the sense of firm's sales growth rate, the growth rate of sales as a dependent variable. And if we substitute as growth rate of total asset, we find that still the change is negative. And if we look at here, we find that the size groups, if we divide firms into different sizes, we find that the establishment of these local banks lowered small firms' growth rate more. So for SME firm, and which is robust to pooled OIS as well. And there is a heterogeneity impact of CCP on firm growth. Okay, so if we look at, for column 1, for example, the regression 1, the CCP establishment has a negative impact on GDP growth, firm's growth rate. But if we times CCP with total asset, we find that larger firms, they actually have a benefit from the CCP presence, where small firms small firms get hurt. So which confirms the evidence I presented before, that there is chronic capitalism in the sense that the larger firms may pay bribe to the city government or mayors or to get credits from local government. So big firms grow relatively quickly. And our results are quite robust to the IB estimation as well, which means if we take consideration the indigeneity problem. And we can see that they are still quite significant. And if we use the bank efficiency measure developed by Berger's paper with using a complicated formula, we find that the city commercial bank's efficiency index is actually lower than the big four, the state-owned banks, which were traditionally claimed to be very inefficient. So here's a discussion. The possible reasons for the poor performance of city commercial banks. The local government has a large influence over CCB versus Big Four, has a balance of power among city, provincial, and central government. And there is a monetary decentralization or credit decentralization. And it's well documented in the political literature that local government is more corrupted than central government. Same thing happens in China as well. As there is more transparency, more balance of power in central government, such as 7 members in political standing committee of CPC, which is being investigated, the series developed by my PhD professor at University of Minnesota, where I get my PhD, is that because, for example, in China, the decision power of the president, Xi Jinping, he's actually constrained by the 7 political members in the political committee. But as a village leader or the mayor, the power for the mayor is less constrained. Oh, okay, sorry. And so here, I developed a very simple model that there is, because this is actually a very preliminary work, there is credit decentralization. Firms pay bribes to the politician to obtain credits as local government controls the bank. The larger firms pay higher bribes. Local banks prefers larger firms. The bribe should be larger than the risk of being punished for taking bribes. Larger firms are inefficient since there is a decrease in return to scale on capital. Therefore, local banks reduce growth rate more. And for nationwide, banks are more efficient. As politicians in central government has a higher risk of being punished. Local government has more corruption than local government. So here should be central government. Therefore, nationwide banks prefers a very few large firms in the country, which makes these firms more efficient. So here, again, very preliminary work. So here is local government's target, WI, which is his welfare. So one part is from public goods consumption of the people in that city, and another part is what bribe he can get. Bribe is fine, which is a risk, the share, the output being taken from the firm as a bribe, and the K is the firm F in city I's capital. Okay, the big I is the investment by the local government to the local firms. And here is the firm's budget constraint, and the city's government's budget constraint, and there is delta is bigger than 1. Okay, so G is the public goods consumption. B is the total budget of the local government. There is a costly transfer money from the government budget constraint to local banks because of political pressure and everything. And the summation of all the credits for all the firms in the city is equal to the city commercial bank's size. And the corruption level, the bribes paid to the politician, it should be bigger than the political risk of the corruption level inside the city. And we find a solution here in the sense that government would use the city commercial banks more if the corruption level in the city gets higher. And there are two propositions. One is that the presence of local banks reduce the GDP growth rate by allocating credits to larger firms. Because of decreasing return to scale of large firms, they are relatively less productive compared to small firms. The proposition 2 is that the central government, which is less corrupted than local government, has a higher F, will reduce the detrimental effect from allocating funds to large firms. This explains the relative better performance of nationwide banks. So why government officials still have incentive to establish local banks with a lower GDP growth rate? Because in China, government promotion based on 2 items. One is that one is the connection. The other is the GDP performance. That the politician weighs between corruption and promotion. Connection and GDP, both important factors for government official promotion. Controlling local banks might give edge to politicians to establish connections by financing connected politicians' related interests at the upper level, which is another factor leading to promotion. So here's a conclusion of my paper that these local banks reduce the growth rate. Thank you all. I'm very honored to attend this very high-level conference, and I'm very happy to be in India to present my paper about developing countries' finance and growth. Yeah, very happy to be here.
Thanks. What you don't know is that the story you're telling is incredibly interesting to all of us here, because we have cooperative banks all around the country that are run by politicians, and we have very similar stories.
Thank you.
So there is a reason why your paper was chosen in this conference.
Thank you. They have access to finance, like what you mentioned, like from Bank of China, right? Or ICBC, other big 4 companies. So they can still access to this finance, but one thing is that the big 4 banks, they might have lower deposits from the emergence of these small local banks. So the small local banks, they have more, the deposits taken because some reason like home buyers that people prefer the bank carries their own city's name or something. Then these banks, newly emerged banks, were discriminated against small banks because of corruption lending, which lowered the growth rate. So if we can think about the model, it's not the firm during the between matters, it is the firm among the top, which means the big firms or the small firms matters. The change of the shift of the size distribution of the firm size change the growth rate, because a small firm, we often think that contributes to growth rate more, right? And switch more resources to large firms will reduce the GDP growth rate. So that's why we have the firm side story.
So you're arguing that at the national level banks use local deposits to give to local firms, because one would imagine that fine, there might be lower deposits at a national level bank from that city, but because it's a national level bank, it shouldn't care so much about, oh, fine, I have less deposit from this city, but I have all the deposit from other cities. They would still lend to that cities, right?
Yes, it's strongly correlated inside the cities deposits and the lending. So usually it's hard for, even though it's a nationwide bank, to transfer one city's money to another.
Okay.
Yeah.
Vimal, you want to say something?
Just to add to Prachi's comment
Okay,
on
thank you.
identification, one
Yeah.
of the things that you may want to try and do is, before the introduction of the CCB in the city, if the firm had, if you can find out who are the top 5 lenders to the firm, it gives you a very clear regression discontinuity to exploit, because you know that introduction of the CCB has given the firm an opportunity to move away from their earlier existing top banks that they borrowed from. And therefore, it gives you a very clear identification, and you don't need IVs to use to estimate this effects. Because you would run into, even if you use GMM, unfortunately, I just saw your sample size is between about 6 years on the whole. And when you're talking about macro effects of this size, it's going to be very difficult for you to use lagged IV instruments, even in your Arellano bond estimation.
Yeah.
So you may want to try the regression discontinuity. The other possible identification strategy for you at the city level will be if you can find out what fraction of the, what is the presence of the national bank in that particular city. So in other words, if you could find similar cities and do a propensity score approach, that would be equally more convincing than using a simple fixed effects estimation strategy.
Yeah.
I also thought that this problem had a simple estimation strategy, which was propensity score matching. So you find a comparable city where the CCB did not come, and then the DID, and you demonstrate to us that the control and the treatment are alike. Right now, I worry that there's a very big difference between the treated and the controls. And then you're really in a logjam of trying to persuade us that the result works.
Yeah, and for the year concerned, that before the year 2000, we have to collect the data year by year. So it's a very heavy work, and we have already done that. The thing is that I'm in a quite a bad health condition for these 3 months, so I can't look at the computer because of my eye. That we have not finished the results yet, but we have expanded our GDP to 1993. Which is far beyond that. The data work is
but
quite...
your instrument will still be very weak.
We should continue this offline. One last comment from Renuka.
Hi. So, just some thoughts on the mechanism that we've been talking about, right? So one way that I could think of that this affects growth negatively is that earlier bad firms who would not have gotten access to finance for good reason. I mean, the banks would not have lent to these firms, but now they are getting money because of these CCBs and because of local political connections. And then once they come into the market, they drive out, there are general equilibrium effects which end up driving out, these other good firms or the firms on the margin. And maybe that's something that you could explore a little more in detail in your work. For example, if there are more details on the kinds of firms that are now getting more money, or the shareholding of the firms, if you have firm level databases in those cities, then maybe you could highlight some of those aspects which might clarify these mechanism issues.
Okay, thank you.
One last comment. We have to really shift to the next paper.
Ajay, in the light of this research paper, what do you feel that in Indian context we are thinking about having a small banks and all that stuff? Already the experience of cooperative banks is also known.
Okay, I think we are doing research papers.
The one thing is that I think China and India are in both high GDP growth rate, but in a different institutional context. My country is in a weak institutional context. I think India, as the Schleifer's papers, British colony, they have the British law, like Hong Kong, Singapore, or India. You can have very good financial development rather than the socialist economy, or like China has a German law. these countries that we have relatively weak the financial development aspect. And in China as well, even the firms, because China right now is proposing private banks in China. There are some very little private banks, and they are quite inefficient as well because they are in that city. The city government can easily control the very small private banks. And in China, that's a whole thing. The government controls basically everything, but the local government has more corruption problem in controlling these private banks. Yeah, thank you.
Okay, we should really stop on this paper. And we'll keep doing this over lunch. By the way, I think that Bombay municipality has more corruption than government of India. So I think that is. So I agree with the story being told, but that's lunch territory.
So thank you very much for the interesting paper. Let me. I'm not an expert in this area, but I'll just try to understand what you do and make a few suggestions. I have to start with the disclaimer that these are my personal views. So let me start by summarizing the paper. So basically, the main question which Chunyang and his co-authors are trying to address is what is the effect of these city commercial banks, CCBs, on economic growth using, and they use a panel data set to address this question. They do a panel analysis at two levels. One is the city level, and the other is the firm level. And this is, of course, this question is plagued by huge identification issues. So they try to use an instrumental variable strategy to address this question. Let me summarize the findings as I understand. The finding is that CCBs, city commercial banks, reduce city level growth. They also reduce firm level growth, especially for smaller firms. And the story is basically that CCBs are less efficient due to local government power. Basically, there's corruption and they exercise power. So my comments will be in two parts. First, let me think about the story you are giving and whether I find it convincing, and then I'll go into the empirical findings and make some suggestions. To a person who's actually not worked in this literature, growth and existence of CCB seem to be too distant to me. So, when you present these regressions, the first question that comes to my mind is, what is the mechanism? Is it through lending? Is it through interest rates? So, it would be really nice if you could get data at the city level on lending or interest rates, rather than looking at city level growth. And being in India, these growth figures typically at a sub-national level, I'm quite skeptical about them. So I would focus on what the mechanisms are. If you had shown me an estimation where you looked at lending or interest rates, I would be a little bit more convinced. This story about local government power, maybe, explaining the lower efficiency of banks, I did not find it very convincing, mainly because, you have only 5 banks, first of all, right? These big 4 or 5, which you compare it with the CCBs. So, lower efficiency of CCBs, I think you need to do more work to convince that, they are really less efficient. Then, if your main story is that, decentralization does not work. Basically, these, local governments exercise corruption. But, there's also a story about better monitoring, right? Because they are, decentralized, they are in the cities, so they can, monitor these banks more closely. So it doesn't seem to me that, a state-owned bank which is located in Shanghai can actually do better monitoring relative to these local banks. So again, for me to be convinced about the story, I would need more evidence. Let me move to my second, point, which is on empirical findings. So, there's a huge identification problem that, which you recognize in the paper as well. The ordinary least squares estimates are, we cannot believe in them as much as we would like to. So, what you do is basically you look at CCBs in neighboring cities and you use that as an instrument, right? And then I ask myself, is the identification assumption really plausible? For example, existence of CCBs in the neighboring cities could be correlated with these non-CCB banks, right? And that could have a direct effect on lending or growth rate, right? So though you say that, they've actually not allowed to do cross-border operations during the time period you're looking at, but, they could be correlated with a lot of other things which could have a direct impact on this city's growth. So I know that the identification assumption is non-testable, but, some more, any more evidence you could provide why we should believe this assumption to be plausible would kind of make your story stronger. Then the second point I wondered, there's no instrument in the firm level regressions. So the firm level regressions are also plagued by the same endogeneity issues. And the firm level regressions are, if anything, you tend to believe more than looking at city level growth. Firm level, at least you're looking at sales at the firm level. So, maybe I don't have concrete ideas, but, because, this question is so much plagued by identification issues that even at the firm level, if, you could use an IV strategy, that would perhaps increase, make me believe more the results. Then the other thing I wondered about, it's a hugely selected sample. So, about, I think, 100 or something cities have commercial banks out of total of 286 cities, right? So what is the first stage and what determines whether a city is selected to have a CCB? And this issue is different from the endogeneity issue. This is a sample selection issue. Even if there was no selection, you could still have the endogeneity issues which you talked about, that, increase in growth could be associated with whether CCB exists or not. But, the selection issue, the fact that you have a selected sample is itself, creates all these selection biases. So I would deal with both these issues, selection issue and endogeneity issue, in two different steps. And, try to think about what is the first stage. If you can show us something on what determines which year, these cities get the CCBs, that would perhaps add to your story. Again, one thing I was really puzzled about, you have a panel data model, you have a lag-dependent variable, and you have fixed effects. You don't use GMM. So if you have a panel data model with a lag-dependent variable and fixed effects, there's straight biases, right? The estimates are biased. So you have to use GMM in that, in that case. So I was a bit surprised on the main estimates in the paper, that, you have a panel data model with lag-dependent variable, with fixed effects, there's straight, bias issues. So you have to show us the GMM is not the ideal solution, but, at least it's some, it's better than running the model with a lag-dependent variable and fixed effects. The other thing I wondered about in the empirical part was, in the firm level regressions, which I actually would like to believe more, you don't control for city characteristics. You only control for firm fixed effects and year fixed effects. You don't control, a firm in you could still, the results could be driven by unobserved city-specific characteristics. So you could easily throw in city fixed effects in those estimations. So with this, I'll just, overall, I thought it was a very interesting paper, but if I were your referee, I would need more work to convince a skeptical referee. Thank you very much.